Hello friends, welcome back. In this today's session, we are going to do a multiple choice question practice for external financial reporting decision chapter. In the previous lessons, we covered the important topics from external financial reporting decisions. So today, we will do a practice of multiple choice question from this chapter. So directly, let's move into the questions. First one, a construction company enters into a contract to build a warehouse for 1 million. The contract includes 100,000 bonus if the project is completed within 6 months. The company has significant experience with a similar project and estimates a 70% probability of early completion and a 30% probability of delay. Using the most likely amount method, what is the total transaction price the company should record? So, here before answering a question, the first important thing is you have to understand the question and what is the exact question that asking or what it means, that you have to understand before solving a question. So, in this question, it is asking what is the total transaction price the company should record, the total transaction price. The total transaction price include 1 million, this is the contract price, plus there is a 100,000 bonus if the project is completed within 6 months. And the company has significant experience with a similar project and estimate 70% probability of early completion and a 30% probability of delay. So, based on the most likely amount method, you can add this 100,000 also to the contract price. The actual answer is the total contract value is $1,100,000. Option C is the right answer here. The first thing you have to do before answering a question is to try to understand question 100%. You have to understand the question first thing, and the second thing, see the question requirement. What is exactly the question mean and what is exactly it is asking. Before doing these two things, please don't try to answer any question, so it will lead to a wrong option. Here option C is the right answer. So, let us move into next question. Before going there, you can see the explanation here. Let us move into question number 2. So, I suggest you pause each question and try to answer yourself before going into answer. Question number 2, a company using LIFO method for inventory begin the year with a 5,000 unit at $10 each. During the year, the company purchases 10,000 units at 20 each, but sell 12,000 units. What is the impact of LIFO liquidation on cost of goods sold compared if they had purchased enough unit to avoid the liquidation? Now, you can see that here the stock liquidation happened. Company has an opening stock of 5,000 pieces at the rate of $10. Again, the company purchased another 10,000 units at the rate of $20. And the company sold 12,000 unit this is the sales quantity. So, here a liquidation happened. The company total purchased only 10,000 unit and the balance 2,000 unit is sold from this opening balance. So, here the question is, what is the impact of LIFO liquidation on cost of goods sold compared to if they had purchased enough unit to avoid liquidation? Now, with this LIFO liquidation, it seems that the company have a better cost of goods sold or lower cost of goods sold, because it sold 2,000 units from the old stock with a better price or with a better cost. So, the cost saving per unit is $10 and 2000 unit 2000 in pieces. So, the total cost of goods sold over will be 20,000. With this stock liquidation, when it's compared to they purchased enough stock to avoid the liquidation. You can see the option B is the right answer here. Cost of goods sold will be $20,000 lower because of this liquidation. You can see the explanation here. Let us move into question number 3. When reconciling net income to cash flow from operations, how should a 5,000 gain on sale of equipment and 2,000 increase in inventory be treated? We learned about this before, how we are to prepare the cash flow statement from the income statement or from the net income. So, with this preparation process, how you have to treat this 5,000 gain on sale of equipment and 2,000 increase in the inventory. First thing, gain on sale of equipment 5,000. This is not an operating activity, so this has to be subtracted. This 5,000 has to be subtracted because you are preparing cash flow from the operations. Gain on sale of equipment is not a operating activity. So, you have to reduce this from the net income. The second thing, a 2,000 increase in the inventory. Inventory increase mean you are invested more amount or you are invested more cash into inventory. This is also an outflow. This also has to be reduced. If you are looking into options, you can find that option C is the right answer. You have to reduce this 5,000 gain on sale of equipment plus inventory, increase in inventory to be also has to be reduced. You can see the answer and explanation here. Let us move into question number 4. A company owns 30% of a company B's and use equity method. During the year, company B reports net income 100,000 and pay total dividend of 40,000. What is the net increase in the company's investment in company's A's investment in company B's account? Under equity method, we already learned that if the company generated net income, the portion of that net income or your portion of that, your interest of that net income can be considered as a increase in your investment. In this case, it is 30,000. Once the company generated 100,000 net income, you can immediately consider an increase in your investment account 30,000. Then the company pays total dividend of 40,000. Once the company pays dividend, it has to be reduced from your investment account. So, this 40,000 into 30%, that means 12,000. The final answer is here 18,000 increase in the investment account. If you are looking to options, option C is the right answer. You can see the explanation here. Let us move into question number 5. A lessee sign a 5-year lease for an asset with a useful life of 10 years. There is no transfer of ownership or purchase option. The present value of lease payment is 60% of asset's fair value. Under US GAAP, how should this lease be classified? Here is a case of lease. It is 5-year lease but the asset useful life is 10 years and there is no ownership transfer option. And the present value of all lease payment is 60% of assets fair value. So, under the US GAAP, you can see that it is operating lease because none of the financing lease criteria are satisfying here. This is a operating lease. So, you can see the explanation here. For the financing lease, there should be 5 criteria. The first one, transfer of ownership. If there will be an option to transfer of ownership at the end of the lease period or during the lease period, it is a financing lease. Then the purchase option. If the lease include a purchase option, then it is a financing lease. Then the asset useful life, more than 75% or 75% of asset useful life included in the lease terms, then it is a financing lease. Then the present value of all lease payment is 90% or more than 90% of assets fair value, then it is a financing lease. Then lastly, if it is a specialized asset for a particular company, for that particular company, then it can be classified as a financing lease. If you are looking into question, none of these criteria are meeting, so it is a operating lease. If any of these criteria are meeting or satisfying in a lease agreement, it can be classified as a financing lease. Let us move into question number 6. A company factor 100,000 of receivable with recourse. The factor charges 5% fee and retain 10% to cover sales return. How should the company initially record with recourse obligation? Option A reduction in fee expenses. Option B, as a liability representing the estimated fair value of the recourse obligation. Option C, as a contra asset to assess accounts receivable. Option D, it is not recorded, it is only disclosed in the notes. If you are looking into option, you can see that option B is the right answer here. So, for this retain amount, there has to be a liability has to be created and there will be a provision has to be created against that recourse obligation. It has to be recorded as an expense and as a liability in the financial record. You can see the answer and explanation here. Let us move into question number 7. Which of the following items is included in the accumulated other comprehensive income on the balance sheet? Option A, treasury stock. Option B, unrealized gain on trading securities. Option C, foreign currency transaction adjustments. Option D, retained earnings. Which of these items included in the accumulated other comprehensive income on the balance sheet? If you are looking into this option, you can find that option C is the right answer here. None of other options are not will show on the accumulated other comprehensive income statement. Only foreign currency transaction adjustment will appear in the accumulated other comprehensive income statement or accumulated other comprehensive balance in the balance sheet. You can see the answer and explanation here. Let us move into question number 8. A company determines that the machine with a carrying value of 50,000 is impaired and write it down to its fair value 30,000. A year later, the fair value of machine rises to 45,000. Under US GAAP, the company should option A recognize a gain of 15,000, option B recognize a gain of 5,000, option C not recognize any gain on or recovery, option D restore the asset to 50,000. Once you write down an asset, as per the US GAAP, there is no revision or not recovery of that assets. If you are looking into option C is the right answer here. Once the fair value rise to another or to 45, in this case it is 45,000. So, there will be no need to recognize any gain on recovery in the financial records. Once you write down your asset value, you cannot write back that asset value as per US GAAP. You can see the explanation here. Let's move into question number 9. Which of the following is a mandatory disclosure in the notes to financial statement? Option A, detailed biography of all middle management employees. Option B, significant accounting policies such as basis of consolidation and inventory method. Option C, list of all competitors and their market share. Option D, internal projections for the next 5 years sales. Notes to financial statement, we already discussed this multiple times. It should be included significant accounting policies such as basis of consolidation and inventory valuation methods used and the depreciation methods used. Option B is the right answer. You can see the explanation here. Let's move into question number 10. Alpha Corps acquire 100% of Beta Incorporation for a cash payment of 1.2 million. At the date of acquisition, Beta's balance sheet show total asset of 1.5 million and total liabilities of 600,000. An appraisal reveals that Beta's equipment is undervalued by 100,000 and it has an unrecorded patent with a fair value of 50,000. What amount of goodwill should Alpha Corp record? So, here the question is how much the goodwill has to be recorded in this transaction. The first thing, you have to see the difference between total asset and total liabilities. It is 1.5 million minus 600,000. It is 900,000. We paid extra. 900,000 is the asset value if you are looking into the company's balance sheet. There will be a total asset of 1.5 million and total liability of 600,000. In this case, the total net asset value is 900,000. With the net asset value, there will be undervalued asset of 100,000. You can write back that into the asset valuation, net asset value. Here it is 1 million. If you add that 100,000, it is 1 million. Plus, it has an unrecorded patent with a fair value of 50,000. This 50,000 also you can add back to the net asset value. The final asset value of this Beta Incorporation is 1,050,000. For the 1,050,000 asset, the company total how much it is paid? It is 1.2 million paid. This difference you can consider as a goodwill. In this case, it will be 150,000. How we are going to calculate the goodwill of during acquisition? It is the difference between how much we paid but minus the net asset value. In this case, the net asset value is 1,150,000 and you paid total 1.2 million. This difference, so this difference is 150,000 is the goodwill value Alpha Corp should record. You can see the explanation here. This is about today's discussion. If you have any doubt in any of these multiple choice questions, please ask me on the comment section. Thank you for watching this video.